Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today is a really interesting topic. Is it time to invest in tech again, Paul?
I think before I answer that question, Peter, I might just show you some graphs of some of the major US and Australian tech companies. First one's Microsoft, and you can see that that's come off a bit, but started to bounce a little bit. And Microsoft, of course, is very profitable tech, Peter. It's a very cash-rich company.
It's a blue chip of the tech world, isn't it?
It is, but a big drop off, but a bit of a bounce there. PayPal, on the other hand, which is also profitable, it's the old spin-off from eBay, Peter. Look, it's had a huge fall from about $300 down to $100. This is in US dollars, not a big bounce. And yeah, you say that that's been more than just a tech sell-off. There's been really a de-rating, I think, of the payment sector, but PayPal's really copped it badly.
But they are tech companies in their own right, but with a specific little area called payments. And this is like the blue chip of the payments.
It is, very much so. Another one is Block, is probably also the blue chip of the payments. This is the old Square. Of course, the Australian business Afterpay, you now owns effectively shares in Block. Again, a big fall there, not a huge bounce. In fact, it still suggests it's doing a lot of work down here. So I don't think ex-Afterpay shareholders are going to like that too much. Let's look at a couple of the Australian stocks, a couple of the leaders. Xero, Peter, around about $100. We were travelling pretty closely around $150 for the most of the last 12 months. Again, not much of a bounce yet, and suggesting that there's still some work to do for Xero. Xero is notionally profitable. It certainly could really ramp up its EBITDA if it stopped reinvesting, but it is, you'd have to say, almost in the profitable category.
And it is locally a blue chip tech stock.
It is locally a blue chip tech stock. And then finally, the last one is NextDC, Peter, which is building the data centres. It's actually had pretty good bounce. It's actually it's done well since January. If anything, the sell-off was probably a little bit beforehand, and maybe people are seeing for what it is. It's an investment in data centres and a growth that there's just going to be a lot more demand for that. Yeah. So look, putting all those together, I think you can see that, okay, some of the big names in the US have bounced, but in the payment sector, they really haven't. In Australia, we haven't seen much of a bounce at all. And I think with the what's going on in terms of the major sectors, resources, particularly around BHP, where the market still looks underweight, and secondly, the banks being supported. When a lot of institutional money is going into those two major sectors, there's not a lot of money left over for tech stocks.
Yeah, so should we call what we're seeing now a bit of a sneak preview of what might eventually happen when the big fund managers realise that they're too long BHP and the financials and all that sort of stuff? They'll take their profit and look around for these growth companies that will benefit if there's high growth later in 2022, 2023.
Yeah, look, I think a sneak preview is a good way to describe it, Peter, because we know that markets and fund managers, they rotate, right?
Yeah, they do.
The rotations usually last a little while, and this tech sector sort of rotation out of tech, look, I guess it started last October, November, when people got serious about higher interest rates, but we've still seen the bond rate in the US still hitting another high, just in the last couple of days. So rates are still going up. The reason why people were getting out of tech, which is really a valuation question, they're still current. So I don't think we're into the rotation yet, Pete, and I think it's, in an Australian sense, it's too early to be going back into tech. I think a preview of what's happening. There's no doubt there's some bargains, but I think that what we will see will be basically for the so-called blue chip. People will buy quality first, and I think if they're second-tier tech stocks, they've got a lot of hard work still to come.
And the bottom line is, if you buy now, you're going to have to wait for the big and better returns in the future. And what I like, Paul, about these ones you've shown us is they've all has sustained rise off the bottom, and that can sometimes be a time to come in. You don't want to guess when they're going up and down on a falling trend. At least they're going up and down on a rising trend, but you are looking at the blue chip of tech stocks.
Yeah, and you've got to buy when other people don't want them, right? But just don't expect to see a massive rebound, because markets I don't think they work that way. And I think the factor, as I said, that's driving has driven the sell-off, which has really been higher interest rates. They're still going up, right? Bond rates are still going up. And that's, of course, impacting valuations. Now, the upside of that is, of course, more growth, and that should be good long term. But we're not through that cycle yet, and I don't think the market's yet quite ready, particularly in the Australian context where, as I said, resources and BHP and financials to get weight back into technology.
Yeah, and I suspect we need to believe that the challenges from the coronavirus and its many strains and forms is right out of the way, and that's when we'll see some spectacular growth, and that's probably when tech stocks will start making a rebound. That's what's through Investing Insights, brought to you by nabtrade. Thanks for joining us.